Hello, I'm James Hibbs, Head of Melville Douglas Diversified International. Shortly, Natalie, Head of Diversified in South Africa, will talk to the outlook for markets and our portfolio positioning. But to begin with, I'll look back at what happened last year and discuss our performance. Starting with fixed income, 2021 was a negative year for bond markets as yield moved higher. The peak in yields actually came back in the first quarter, following upward revisions to global growth and increasing inflationary expectations on the back of further stimulus measures in the US and hopes that the Western world was emerging from the worst of the pandemic. In reality, the economic recovery was not as straightforward, as new COVID variants emerged, and as you can see from the chart, fixed income markets recovered post their March lows. However, in Q4, investors became more concerned about higher inflation, questioning the ongoing transitory rhetoric from central banks as a combination of the demand-side recovery, fiscal stimulus, supply-side bottlenecks, labour shortages, and the very easy monetary stance of most central banks were increasingly seen as fueling growing inflationary pressures. The sell-off in bond markets has accelerated this year as investors have significantly recalibrated the pace of interest rate rises required to rein in inflation, something Natalie will touch on in more detail. In contrast, it was another very strong year for equity markets, with a 6% gain for the world index in Q4, despite a November wobble, capping a return of over 18% for 2021 as a whole. The US market once again led the way, with the S&P 500 index returning almost 29%, followed by European markets that rose by over 22%. Emerging markets, on the other hand, actually delivered a negative return, as stricter COVID lockdown measures in some countries and a drawdown in Chinese equities on the back of new regulations on certain sectors weighed on the region. Despite last year's stellar returns for equities, they in fact got cheaper, as stronger than expected earnings growth of 50% globally easily outpaced the increase in share prices. Valuations were therefore reasonable heading into 2022, and outside the US, trading below long-term averages. Unfortunately, the welcomed re-rating in valuations has not prevented a somewhat rocky start to the year. The more expensive quality growth area of the market has sold off significantly on the back of more hawkish central banks, whilst more recently the threat of conflict in Eastern Europe has also kept risk assets under pressure. In just the first 7 weeks of the year, there's been a huge dispersion of returns between sectors and regions. However, a drawdown of around 7% for the world index at the time of filming should be viewed in the context of the still 80% recovery from the COVID-induced lows of March 2020, and the fact that price corrections of more than 10% are commonplace in equity markets, happening on average around once every 15 months. Though 2021 was a strong year for equity markets, it was also a rather challenging one for global equity managers to outperform. This chart shows the performance of global managers in 2020 on the y-axis and 2021 on the x, with our three global managers also shown. Unsurprisingly, given the backdrop, our value manager, Dodge & Cox, outperformed the market in 2021, having underperformed in 2020, and for our growth manager, Artisan, the reverse is true. However, both outperformed their specific style index in aggregate, adding value over and above any market dynamics, and exactly what we'd be looking for from our active managers. Our core holding, which makes up the majority of our global equity exposure, is in the Standard Global Equity Fund, which allocates capital to 6 different leading managers, blending their different skill sets to target a largely style-neutral approach, which is reflected in the slight outperformance in aggregate over the 2-year period. Focusing on last year, all of the funds below the horizontal line on the chart underperformed the market. That's 83% of global equity managers failing to beat the market last year, with over a third of managers underperforming by more than 10%. So why was this? Well, firstly, share price leadership was extremely narrow, with only very cyclical or very growthy companies making up the lion's share of outperformers. Many of the highly cyclical names were too poor quality or too volatile for active managers to own, whilst many of the extremely growthy names, found largely in the US, were deemed too expensive. In aggregate, managers were underweight both the US, which was the best performing region, and energy, the best performing sector, which was up 55% in the US and 36% globally. And to highlight the narrowness of the market, the top 5 contributors accounted for 9% of the index performance. One of these was Tesla, which very few managers own due to governance or valuation concerns, yet it contributed over 0.5% of performance to the world index, and proved to be a big headwind for most managers. The final quarter of 2021 saw our equity exposure underperform on a relative basis, which unfortunately led to our model portfolios giving back the very strong outperformance to benchmark seen at the end of the third quarter, and in turn has led our sterling and dollar equity portfolios to close the year behind benchmark. However, when looking at the performance relative to our peers, it can be seen that we outperformed the peer group index across the board, and the difference in relative performance of our equity strategies versus benchmark and peers again serves to highlight the challenging environment for global equity managers in 2021. For our multi-asset portfolios, our top-down asset allocation positioning, overweight equity, maximum underweight fixed income, pleasingly added value throughout the year, as did the defensive positioning, both from us and our managers, of our fixed income allocation. Our value equity managers both outperformed the value index, whilst our European equity managers, in particular our growth manager, added very good value and led to very strong outperformance to both benchmark and peer group for our Euro strategies. What didn't work was our UK equity managers, with the quality bias and defensive positioning of two of our managers leading to significant underperformance of the UK market. Our global growth managers were also a drag, as both were underweight the mega-cap tech area of the market on valuation grounds. Overall, despite the testing environment, our client portfolios enjoyed favourable returns, especially compared to peer group. I'll now hand you over to Natalie in South Africa.
So thank you, James, and hello to our viewers. The volatility and recent downturn in equity markets is primarily due to the sudden hawkish behaviour by a number of prominent central banks. This change in rhetoric has been led by the spike in inflation on supply and demand imbalances in relation to the pandemic and the strength in the labour market, specifically in the US, where unemployment levels are at those seen prior to the pandemic. Central banks have brought forward and accelerated their expectations of future interest rate hikes and are looking to reduce their inflated balance sheets. Last year, the market was anticipating one interest rate hike by the US Federal Reserve in 2022, but now the market is anticipating 5 to 6, even 7 hikes. The graph in the presentation shows the FOMC's meeting dates over the course of the year and the projected number of hikes and related implied policy rate. By January 2023, this graph is a little out of date even, we're looking at the forecasted base rate of 1.75% and approximately 6 hikes. The first rate hike in March is almost guaranteed with a 50% probability of a 50 basis points increase. If it is higher than 50 basis points, this would definitely surprise the market. To ensure the Federal Reserve does not fall behind the curve, they need to ensure inflation remains under control. Over 2021, we saw a large spike in the underlying inflation rate, well above the 2% Federal Reserve's target rate. Inflation reached 7.5% in January. Again, the chart is a little out of date, on supply chain issues, pent-up demand and excessive stimulus packages. We expect inflation to move lower over the latter half of 2022 as supply constraints ease, consumer energy prices slow and base effects feed through, which should help ease some of the market concerns. The risks are, however, to the upside. If supply chains get disrupted again with another COVID strain, and irrespective of the strain, China's zero COVID policy, geopolitical risks are another risk, especially the conflict in Ukraine and Russia, which could further increase energy prices or exacerbate global supply shortages. But despite the risks, economic growth should remain above trend in 2022. Although lower than figures in 2021, given the rebound from a very low base. Companies should continue to benefit from the reopening of the global economy and more people in jobs. Given the fundamental backdrop, we have retained our significant overweight in global equities. Equity markets generally trend higher unless the economy enters a recessionary period. You can see in the graph, where the grey bars indicate US recessions, how the global equity market only suffers from significant corrections over such periods. If you look at prior tried and tested recessionary indicators from a manufacturing, yield curve, employment and monetary perspective, all are very positive and not indicating concern. To fund the overweight in equities, we have a corresponding maximum underweight in fixed income. A rising interest rate environment does not bear well for the asset class. With respect to our underlying managers within equities, we have a good balanced mix of different styles with different alpha drivers. We take a style-neutral approach over the longer term. However, our underlying managers currently have a value bias. Hosking, a contrarian manager with a capital cycle approach invested in areas of the market that are less attractive, has a more significant value tilt today than what we've seen from them since 2003. They specifically have large overweights in financials and materials. Sanders also has a large overweight in financials, and Arrow Street, our quantitative-based manager, is also finding more opportunities in the less expensive area of the market. Our underlying active bond managers also remain short duration on the premise of increased yields and favour corporate bonds given strong underlying company fundamentals. In conclusion, we recommend staying invested in real assets like equities that benefit from a higher inflation and above trend economic growth environment, but to expect more volatility given tightening monetary policy, especially to the higher growth area of the equity market. To assist in protecting your portfolio, we recommend diversification across equity styles, blending the best in breed third-party asset managers alongside your Melville Douglas focused exposure. And with that, I will hand you back to James for some closing remarks.
Thanks, Natalie, and many thanks to you all for watching. If you'd like to discuss our diversified offering or your portfolio in more detail, please contact me, Natalie, or your usual wealth or portfolio manager.